Hey, welcome in. We're going to talk about Disney today, Disney stock, Disney fundamentals, the company. I went to Disney one time, Paul. I loved it with my kids. I did not want to go and I ended up going. It was wonderful. You don't go that often, but your brother.
I've only been to Disney World once, Disneyland twice, and my brother and his wife.
He's bonkers about this.
Oh, they have a Disney vacation package. They go without kids.
Yeah, he's out of his mind. So Disney, we all know Disney's incredible. It's been an incredible company for a long, long time. Disney Plus is rocking. I do own that, Paul. I love my kids. You know, they love watching the movies, the Hamilton. Disney's incredible, but their parks have not been, obviously, over the past year with the COVID, all the restrictions. They're finally opening up. But in this video, we'd like to give you our thoughts on Disney. Where is it at as a company? Can we invest long term? Can we trade it with Trader Mo? The stats you're going to hear about this company not being open, yet floundering price of stock is mind-boggling, and we'd like to present it to you now. So, Paul, give me your thoughts on Disney, and Mo's going to back you up with a ton of new facts that he knows about this.
Okay, this is the one-year chart on Disney. Okay, actually, let's go even further back. Let's go 5-year chart on Disney. Seth, this is what I don't get.
Go on.
This is when the shutdown occurred. The stock was at 150 or so, and now it's currently at 187 or so. How is it 20% higher? Over 20% higher, and we still haven't come out of the shutdown. They're still not making money from a net income basis. And even if they do open up again, where's the justification for 20% higher than what it is today? Disney Plus, maybe? I don't know. But
this is where I asked you this question, Paul. We've said this on the show multiple times with these gains with Tesla. At what point does this BS, these fundamentals not matter and just hype and euphoria? We can just, obviously we can make money on this because Trader Mo is, but I mean, you tell me, baby. I don't know. This is crazy.
So $340 billion market cap. This is a huge company, guys, as it should be. It's got amazing brands. I love it. As a company, it is a phenomenal company. Net income, negative $5 billion, so no PE and no net profit margin. X's on both. Gross margin of 30%. Okay, they have no more dividend. They were paying a dividend before. I don't think they are anymore. We have to verify that to make sure it's true. But it makes sense that they would cut their dividend to secure cash flow.
Yeah, they cut it.
Income statement.
This is pillar number 3 is revenue growth over the past 5 years.
So even with the big slowdown last year, 55 billion to 60 billion, it's still a check mark. But look at how much it dropped from 19 to 20. Dropped 20% in revenue from 19 to 20, and yet the stock is up over 20%. Think about that. Net income, guys. Net income down here at the bottom.
This is pillar number 4, profit growth over the past 5 years.
9 billion to a loss of 5 billion.
Good boy.
X. I mean, massive drop in net income. $15 billion decrease in revenue, $15 billion decrease in profit, ironically. Shares outstanding, guys. Holy Toledo. 1.59 to 1.81 billion. X there as well.
Good boy.
So we've got a check for revenue, and that's it so far.
That's right. 4
Okay.
X's.
Now, guys, this software is wonderful. This is part of our Everything Money software. 2,000 people have signed up for it. It just started the other day. More on this at the end of the video. If you'd like the software, it'll tell you all the pillars itself, all the data for a very, very low cost. Stay at the end of the video and you'll see all about it.
Keep going, baby. We're at current assets over current liabilities is pillar number 6.
So remember, current assets are the cash on hand, and you want to make sure they have enough cash to pay their current debts. They have $35 billion in current cash. Now, one thing I want to point out to you, Seth,
Please do.
Look how much that's up from December of 18. I don't know why. It's basically doubled. I don't know why that is. I don't know if that's necessarily a good or bad thing, but it's just up a lot. Current liabilities are currently 26.55. So the good news is they have plenty of cash on hand to pay off all their current liabilities. That's a reassuring thing when you realize that there's still going to be probably some losses along the way.
Did this help them? I mean, obviously, this amount of cash and little debt, did this help? Obviously, how did this play in? Here's my question. How did this play in when no one was going to their parks?
Well, the great news is it's a company like Disney. They have so many brands out there. They're going to be able to raise capital very quickly to weather the storm. This is why I like investing in big companies, because I want companies that are going to last a long time. Disney, I would be absolutely floored if even 20 years from now Disney was out of business. I mean, this would be one of the shocker of all shockers. Would we all agree, Seth and Mo?
I would agree with that.
I mean, absolutely floored if Disney Studios was out of business. So this is a company that has staying power, which usually leads to a really high valuation, but I like the fact that their cash on hand is enough to pay their debts. So they're being responsible about that.
Free cash flow is pillar number 7. This is cash from operations minus capital expenditures, Paul.
Now, guys, this is so important to me. Cash flow is way more important to me than net income, and here's why.
Yeah, you love this free cash.
Absolutely, because net income is always going to be affected by accounting rules, SEC, all these rules that are out there. Free cash flow is much harder to manipulate. Free cash flow is cash from operations less capital expenditures. Right here on your income statement, cash from operations, next line, capital expenditures. But what we do here at Everything Money as part of the software, we add the line to the investing section of the cash flow statement. It shouldn't be there, but I added it. It gives you the free cash flow every single year, and I also give you the 5-year average. So 5 years ago, 7.72 billion in free cash flow. Last year, 2.65. So X there.
I'm imagining you're going to throw out a couple years because if you go back in time, look at that nice steady growth, Paul.
Correct. Now that's what we're going to look at here. We're going to look at that after we look at the 6 billion. Their average over the last 5 years is about 6 billion. So their $340 billion market cap divided by 6 equals what? 56.6?
Yeah, it's exactly 56.6. Of course it is.
Okay, that's a huge X.
Boy.
This is what matters to me, guys. Look at these last years. I'm going to go back 10 years. 3.3, 3.68, 6.6, 6.7, 7.3, 7.7, 9.6, 9.5, 2 big drops. So Seth's right. Let's throw these out. But guys, here's the interesting part. Take their best year, 9.57.
I know where you're going with this.
$340 billion market cap. That's what you have to pay for the company right now. Divide it by 9.6. And you're at 35 plus.
35.4.
Price to free cash flow. Guys,
still way too high, Paul.
That's an insane amount. So the thing I'm trying to show you as an investor is, even based on the best year they've had in history in free cash flow, you'd still be paying 35 times free cash flow, assuming their best year ever. I'm avoiding this stock at this price completely.
But Paul, my uncle said I should only invest in companies I like.
And that's why your uncle is broke. I'm just kidding. Guys, it's a very cute thing to say, invest in companies you like.
Cute, adorable, really.
It is adorable. But at the end of the day, does that mean you should pay $3 trillion for Disney because you like them? There's still a reasonable price to pay. And my point is, 35 times their best year's free cash flow in the last 10 is not a reasonable amount of money to pay. How much is a reasonable? You're not going to like it, folks.
Uh-oh. This is where you're going to get blasted. The current price is 182 on the stock price. The market cap is 340. What do you want to pay for this company, Paul?
So,
because as soon as you give this number, people are just going to say, you're an idiot. It's never going back down to this number.
Correct. Yeah, it's bad. I remember last year I said they were worth $80 a share. I'm going to stick to that.
It got down to 85 in the crash.
Yep, I'm going to stick to 80.
And that's the part where people are like, you're crazy, you don't know what you're talking about, it's never going to happen.
Just guess what? Check out our last video, or one of the videos that's coming on Discovery. Just a month ago, it was $75 a share. Now it's 36.
Yeah.
Don't tell me it doesn't happen.
It happens.
All the great companies will be sold at reasonable prices at some point. Because not everything can stay euphorically high forever, guys. I'm asking you, I'm begging you as an astute investor, is to sit here and understand that you're going to have tons of companies to look at. Look at this 8-pillar chart right here. We have 2 checks. Revenue growth, barely, by the way, after a 20% drop, and assets over liabilities. Other than that, every metric is an X. Now, a lot of these checks are because of the fact that COVID happened. Great. I'm asking you, as somebody who's on this channel learning about Disney stock, not just to come here to get validation for buying it at a really high price. Understand that every single stock is a present value of all future cash flows. And paying 35 times every year at their best year's free cash flow is a 3% return on your money. Cash on cash return on your money. If you're okay with a 3% return on cash on your money, give me a call. I'll give you 5% return, and I will go invest in real estate and make a ton of money off of it. And I'm going to increase your cash on cash yield by 66%. So I'm trying to sit here and teach this fundamental way of looking at companies as when you're buying a stock, you're buying a piece of a business. Does it sound boring? Sure. Does it sound hard? Sure. Is it either one of those? Absolutely not. I'm just sitting here saying, Come join it. Come learn. We're learning from each other. Just today in our Discord chat, I asked everybody, hey, what stocks are you looking at right now? And people gave me 4 or 5 stocks. I'm going to look at every single one of them.
So these numbers are 3 to 5. You know, I love you. But as a normal person watching, I don't even know what you're talking about. What does that actually mean? Give me your money.
So when you're buying Disney at 35 times free cash flow, that means whatever price you pay, you're going to get 1/35 of that every single year. Now, obviously, it'll increase over time. So you have to ask yourself, is it worth it for me to own Disney to only get 1/35 of my money back it's going to take me 35 years, assuming it stays stable. Because I remember I took the best year they ever had.
Yeah.
Assuming it stays that best year ever, it's going to take me 35 years to get my money back. Is that a good investment?
You tell me, compared to
the market in general. I mean, we're looking for sub 20 and sub 15, and a lot of value investors look for only single digit. Discovery is at 8.5 times free cash flow versus 35 times their best year. I would much rather have Discovery at 8.5 times their last 5 years average free cash flow than 35 times Disney at 35 times their best year.
What Paul is referring to is we just did a video on Discovery, the company. Yes, Discovery, the TV company. And if you want to see a stock that'll blow your mind with really great numbers and is a buying opportunity, check out that video. We could probably link it below. But yeah, Paul, Disney is the exact opposite of Discovery.
And I love, by the way, do I like Disney more as a company versus Discovery? Absolutely. I think the brand's awesome, but there's still, for somebody who says to me, all that matters is the brand of the company, then you should have no problem paying 10 times Disney's price. Pay 10 times it. Whenever you say it doesn't matter, you would pay an infinite price. We can all agree that infinite price is not reasonable.
Now, the comments below will say, Paul, money can be made on the up and down, so that's where Trader Mo can come in. If you're in that wonderful Bidnass Nation, you know I love you. If you're in the Bidnass Nation, that middle Patreon to you, you're loving Mo. Mo, tell us about Disney from a trading aspect if you want to make some of that cheddar.
So Disney's definitely a short right now. It's coming down through the sweet spot, and we're getting close to that oversold area. Now, would I short this? This is not a stock that I'm going to short. And the reason is I just go back and I look at the history of it. Every time this red line crosses under this yellow, you can see the price movement is, except for these little gaps, there's no movement on it. So I'm in that range right now. So the stock price, there's not really much room for me to make money on the downside. And that's because Disney always has some news coming out that's going to send the price forward. Disney is going to be a very, with the vaccine and this and that, as parks open, I think the fact of the matter is the price is just going to keep going higher for you. So if you're trading this on a chart, I would not be shorting this. All I would be doing is throwing this on my watch list and waiting for us to get some kind of uptrend moving like this. And I mean, we can probably break out into new highs if you keep an eye on it for a very long time.
If you like what you're hearing, you can join our Patreon, Paul, our team. We have crossed 2,000 patrons, a number unfathomable last year, Paul. We did. It's just incredible. The support you've given us is amazing. And of course, if you're in that Patreon and you're on that Discord, you know we love you. The community that we're building is incredible. And Paul, like you said just a moment earlier, is like the amount of info we're getting from our patrons and vice versa. All the stuff we're giving away. The Tesla giveaway, we're giving away 2 Teslas. The Fireside Patreon exclusive videos. The live streams with Trading Only, which is one coming up soon. It's just you're getting so much more than what other YouTubers are giving you for literally the same amount of money. Paul, tell them about the software they're getting.
So months ago, I was using Y Charts to do all this analysis. And Y Charts for an entry is $200 a month. I was paying $500 a month for the professional version. And everybody kept saying to me, Paul, I want this data you're having, but I'm not going to pay $200 a month. Okay, let me create the software. My goal was to sell 725 spots by the end of December 2021. It's currently April 18th or 19th, and we've sold 2,000 spots. Here's what you get. Now, the great thing is, interesting part is, the price keeps going up. It was $8 to start. Now it's $22, on its way to $49 versus $199, $199, and $35. And look at all the things you get. And one of the big things you get is this Discord community of 2,000 people. It sounds like a lot, but there's so many great chats. People have great conversations. It's crazy if you're thinking about, if you love investing and you want to learn more, 60 or 70 cents a day gets you access to all the financial data, that entire website that I use. Go do it. You will not regret it.
If you're on the fringe, check out any of our live streams. Our patrons fill up the comments with what they love. And yeah, it's been incredible for a lot of us. So that is our take on Disney. Wonderful company. Way too expensive stock. If you're interested in joining the Patreon, you've never done it before, give it a shot. I'm certain you'll love it. That's our take. We love you guys. Thanks. Take with a thumbs up on the way out. Love you.